Welcome to the Deep Dive, where we really try to cut through the noise and get to the core of what matters. Have you ever just stared at a trading chart, wondering how some people seem to? Well, just know when to get in or out. Making sense of it all, especially if you're not glued to the screen 24/7, can feel pretty mysterious sometimes.
It really can seem that way. But often, what looks like intuition is actually about understanding some pretty powerful tools and, crucially, how they work together.
Exactly. And that's what we're doing today. We're pulling back the curtain on a few key technical indicators. Think of them as guides for helping you time those entries and exits, especially within trends that are already moving. We're drawing heavily from Suneil's book, A Practical System for Trading Forex. Really practical stuff in there.
It's very grounded.
Yeah. So our mission today is to unpack what oscillators actually are, look into where tools like Parabolic SAR, MACD, and Williams PSAR came from, how they work, the mechanics of it all, and then, importantly, how combining them can give you, the listener, a clearer picture for navigating, say, the Forex market. It's about getting those key nuggets of knowledge to you quickly and effectively.
Getting straight to the point.
Right. Okay, so we've kind of set the scene, finding market guides. But maybe let's start with the basics. What exactly is an oscillator in trading? How does this idea help us time our moves?
Good question. So SK uses this neat analogy in the book. He says, think of an oscillator like an electronic circuit producing alternating current, constantly switching polarity back and forth.
Okay, like a wave.
Sort of, yeah. In trading terms, it means an oscillator is built to spot the short-term dips and rallies within a bigger, longer-term trend. Imagine the market's a river flowing strongly one way. The oscillator helps you see the smaller ripples and eddies on the surface.
Ah, okay. So they aren't really for spotting the main direction the big rivers flow,
Right.
but more the temporary ebbs and flows within it.
Precisely. That's the key distinction.
And what's the big mistake people make then? Using them for the wrong thing.
Yeah, exactly. Their main job is to give you opportunities to potentially take extra trades, but only in line with the main trend that you've already identified using something else. The mistake is trying to use an oscillator to decide the main trend, or worse, trading against the main trend just because an oscillator gives a signal.
Right. So going against the river's flow based on a ripple.
Exactly. Recipe for trouble. Suneil really hammers this home. Always use an oscillator alongside a trend-following indicator. And critically, only trade in the direction that main indicator points towards. Don't fight the current.
Okay, that makes sense. So if oscillators handle the ripples, what about a tool that helps us track the main current itself? Let's talk Parabolic SAR. Who invented this one and what's its main job?
Right, Parabolic SAR. This one comes from a real giant in technical analysis, J. Wells Wilder Jr. He developed a lot of the indicators traders still swear by today.
Ah, Wilder, okay.
Yep. And the beauty of SAR is its dual purpose and how visual it is. You see it as a series of dots on your chart, either above or below the price bars. Its job is twofold. First, to help you determine the trend direction and spot potential reversals. Second, it acts as a dynamic trailing stop-loss point, kind of like a safety net that moves along with the price.
A moving safety net, I like that. But does it ever get tripped up? Like, are there times when it gives, a false signal or the net isn't quite right?
Yeah, like most indicators, it's not foolproof. It tends to struggle in really choppy sideways markets. You can get a lot of flips back and forth that don't really mean much. Suneil actually details specific settings he prefers, possibly to help smooth that out a bit. He uses what you might call a fast setting. The parameters are 0.0006 and 0.0024, shown in yellow, typically on an hourly or H1 chart.
Okay, H1 chart, yellow dots, got it.
And then for a longer-term view, he uses a slower setting, 0.0003 and 0.012 in magenta, which he finds works best on an M30, a 30-minute chart. And here's something really interesting SK points out. That magenta setting on the M30 chart gives almost the same signals as the yellow setting on the H1 chart.
Wait, really? The slower setting on the faster chart looks like the faster setting on the slower chart.
Almost identical, according to Suneil. It's super convenient because it suggests you can monitor that H1 level trend effectively just by looking at your M30 chart with the magenta SAR. It hints at how market patterns can be fractal, sort of repeating across different time frames. Big time saver.
Wow. Okay, that is a handy insight. And the basic trading rule with SAR, just follow the dots.
Pretty much. It's very straightforward. If the SAR dots are plotting below the price bars, the trend is considered up, so you should only be looking for long trades, opportunities to buy. If the SAR dots are above the price bars, trends down, only look for short trades, opportunities to sell. It's a clear visual cue.
Okay, SAR for the trend and the moving stop. Makes sense. but sometimes you want maybe another layer, right? Something measuring momentum differently. That brings us to MAUI-D, another really popular one. How does Suneil suggest using MAUI-D effectively?
Right, MASD. Stands for Moving Average Convergence Divergence. It's quite a versatile tool. It basically looks at the relationship between two different moving averages of price. Think convergence when those averages are getting closer together, maybe momentum is fading. Divergence is when they're moving apart, momentum might be picking up.
Okay.
The standard settings, which Suneil also uses, are 12, 26, and 9. It mainly works by comparing a faster 12-period exponential moving average in EMA with a slower 26-period EMA. The basic idea is if that faster 12 EMA is above the slower 26 EMA, it suggests the recent trend over the last 26 periods is generally upwards.
Simple enough. But are there any warnings or specific ways SK looks at it? You mentioned it can be tricky sometimes.
Yeah, Suneil does caution that MACD can be a bit of a blunt tool, especially when the market gets really volatile or starts whipsawing back and forth. It can give misleading signals then. That's why he really stresses that you must use it alongside other indicators for confirmation. Don't rely on it alone in those conditions.
Makes sense. Combine your tools.
Exactly. And how it's usually plotted is with two lines, one showing the difference between the EMAs and another line which is an average of that difference. But Suneil actually prefers a slightly different view. He often replaces one of the lines with a histogram and tends to just eyeball the height of the last 3 or 4 bars on that histogram.
Oh, interesting. So he's looking more at the strength, the height of those bars, rather than waiting for lines to cross.
Seems that way. It simplifies the visual. For him, it's still fundamentally a trend-following indicator measuring that convergence and divergence. But he takes the signal from the histogram. When those histogram bars are positive, meaning above the zero line, that indicates the faster average has crossed above the slower one, and that's his cue for a potential entry.
Got it. Eyeballing the histogram for positive bars?
Mm-hmm.
Okay. Now there's another oscillator SK highlights, Williams PSAR. Who was Larry Williams, and what's special about this indicator?
Larry Williams, he's a bit of a trading legend, really famous for taking, I think it was $10,000, and turning it into over $1 million in a trading championship back in the day, in a year.
Wow. Okay, so we probably knew a thing or two.
You'd think so. His Williams PSAR is a momentum oscillator. Its specific job is to tell you whether the market is currently trading near the top of its recent range, near the bottom, or somewhere in the middle. It basically measures where the latest closing price is relative to the highest high over a specific look-back period.
And settings. Interpretation.
Yeah.
I heard Suneil might have a slightly different take on the standard settings here, too.
He does. The standard default setting for Williams PSAR is usually 14 periods, but Suneil prefers 13?
13. Why 13?
He often favors prime numbers in his settings. The thinking, as I understand it, is that prime numbers, being only divisible by 1 in themselves, might resonate better with natural market cycles or create less noise than more common, composite numbers like 14. It's about finding a cleaner signal.
Huh. Interesting theory. Okay, so 13 period. And how do you read it?
It fluctuates on a scale from 0 down to -100. Readings up near the top, between 0 and -20, are generally considered overbought. Readings down near the bottom, between -80 and -100, are considered oversold. Extreme levels.
And where does Suneil find it most useful? Which time frame?
For optimal use, he suggests using that 13-period setting on an M30 chart, the 30-minute chart. He finds this combination good for spotting those smaller, maybe 6-hour dips and rallies within the context of a broader, perhaps 13-hour trend. He also notes you can use it on M15 for spotting 3-hour swings, M5 for hourly moves, and even H4, the 4-hour chart, for identifying potentially overbought or oversold conditions over about a 2-day period. It's adaptable.
Right, so you can adjust the time frame to look for different scales of those dips and rallies. Okay, this brings up a really important point. We've got these individual tools, SAR for trend, Williams PSAR for dips rallies. How do we actually put them together effectively, combining an oscillator like Williams PSAR with a trend follower like SAR?
Yes, and this is really the core of making these tools work reliably. It's about synergy. You absolutely hit on the key principle. Oscillators like Williams PSAR are primarily for pinpointing those short-term counter moves, the dips in an uptrend or the rallies in a downtrend, within the larger trend established by something else. You never, ever want to use Williams PSAR, or any oscillator for that matter, to decide the main trend direction on its own. That's what the trend-following indicator, like Parabolic SAR in this case, is for.
So SAR tells you we're generally going up, and then Williams PSAR hitting an oversold level might signal, okay, the dip might be ending, good time to potentially get in line with that uptrend.
Exactly. That's the perfect way to think about it. SAR sets the stage. It tells you which direction the main performance is going. Williams per SAR then helps you time your entrance, ideally catching the moment a temporary pullback finishes and the main trend is likely to resume.
So you're using the oscillator to fine-tune your entry within the bigger picture provided by SAR.
Precisely. You use Williams per SAR to find those ideal entry points during the pullbacks in an uptrend or rallies in a downtrend, but always making sure your trade is aligned with the direction SAR is indicating for that main trend. This whole approach, combining the tools this way, helps you capitalize on those shorter-term fluctuations while still having the protection, you could say, of trading with the dominant market flow. It leads to better risk management, potentially fewer whipsaws, and hopefully more consistent results over time. It's about building a clearer, more reliable market picture.
Fantastic. That really ties it all together. So there you have it. We've taken quite a deep dive into these technical indicators today. We've looked at what oscillators fundamentally are, explored the origins and the nuts and bolts of Parabolic SAR, Mankey D, and Williams per SAR. And critically, we've seen how Suneil's approach in his book helps distill these potentially complex ideas into practical, usable insights for timing your trades within established trends.
Yeah, and understanding how to use these tools properly really can give you, the listener, a significant edge. It helps you navigate that market volatility with a bit more confidence and aim for more consistent returns, whether you're just starting out or you've been trading for a while and want to sharpen your strategy.
Definitely. And here's something that maybe mull over. Think about how these indicators, SAR, Mankey D, Williams per SAR, they're all mechanical, rule-based, rooted in math. How does that contrast with the often emotional, sometimes unpredictable nature of human trading decisions? What might that suggest about where trading strategies could be heading?
That's a great point to ponder. And look, if you want to really get into the weeds with this stuff, see more examples, actual charts showing these indicators in action, we absolutely recommend checking out Suneil's book, A Practical System for Trading Forex. It's packed with detailed, real-world scenarios that genuinely bring all these concepts to life, way more than we can cover here.
Absolutely. Highly recommended if you want to dig deeper.